Let's get started with the conversation on your rate path because, of course, you have signaled another hike that could take the Selic to around 3.5% next month. But swap rates right now pricing in a rate above 6% by year end. What do you make of this?
No, I think it's important to understand what is the market pricing. So I think when you look at the interest rate curve, part of what you see in the long end is referring to a fiscal premium. So Brazil has had a very big fiscal expansion, and that reflects into an uncertainty that gets priced in the long end of the curve, and we see that. But for us, the important thing doing policy is to look at inflation. I mean, we are inflation targeters, so we need to look at inflation. And in that front, looking at inflation is where we are trying to be more transparent and give all the explanations to what we think the path is for interest rates.
But economists are also projecting a rate above 5%. Will the bank need to be more aggressive come year end?
Well, we don't forecast where rates are going to be. What we are basically saying is we understand there is a process of inflation going higher. A lot of this process has to do with components that are not structural, that are temporary. We had an increase in commodities that's not only affecting inflation in Brazil, but it's affecting inflation in other places. You have the food items that are very important for Brazil with energy, and also the food items gives a contamination to ethanol, which also increases prices in the industry. And on the top of that, we had a depreciation. So commodity prices in reais and in the local currency have increased a lot. So we understand that this process is taking place. We understand that this process had some contamination into the core inflation numbers, and we explicitly saying what we are seeing and why we think it's important to do the move that we did in policy. We did 75 basis. We indicated another 75 basis, and we keep vigilant on how this process is developing, looking at all the process of contamination from current inflation.
Will another 75 basis points help when it comes to those inflationary pressures?
Well, we look at what is the horizon that we need to act. So for now, the horizon, the most relevant horizon is 2022. So we look at what needs to be done in terms of adjustment of inflation, recognizing that part of it is temporary, and we think towards the end of the year, the inflation is going to go back lower. And we think we are adjusting rates so that we have our target. And by the way, when you look at the output gap, we also see a convergence in 2022. So those things are aligned.
But you're not planning to take the neutral rate, go back to the neutral rate this year, right? You're still planning to leave some monetary stimulus for 2021.
Yes, no, the question in every meeting, the first question is, do we need stimulative conditions? And the answer is yes, we do. We're still facing a pandemic. We're still facing a country that has many problems. So we do think stimulative conditions. Then the question is, how stimulative they need to be? Remember that when we placed interest rates at 2, we were envisioning a scenario that never happened. People were talking about negative growth in the magnitude of 8-9%. Some people were saying inflation was going to be as low as 1.5%. None of these things materialized. So it's not adjusting inflation for what we think it should be compared to the neutral rate. It's recognizing that the interest rate that we have now was set up for conditions that never materialize, and that we need to move rates but still be on stimulative grounds. And that's why we mentioned the partial normalization process.
But the concern right now is that all of those inflationary pressures that you mentioned, you are considering those as temporary, but we are already seeing second round effects. How do you deal with that? And when do you decide to deal with that?
Well, when you look at, for example, from one Copom meeting to the other, our projection for 2021, it was 3.4, and now it's 5. When you decompose, when you look at inside the number, most of the things are explained by commodity prices and the depreciation and the impact that this has on other chains. So we do recognize that there is some contamination. We think that there is no structural contamination. We think there is most of the effect is temporary, but I mean, nothing is written on stone. We're going to look and see how this develops. We just had a number a recent number of inflation, and it was a bit better than expected. And we saw that the core inflation was actually a bit lower than expected. So we need to watch.
So
remembering that we don't target the very short end. There is a horizon for what we do to take place, and we're looking at 2022 more and more.
And by year end 2021, where do you expect inflation to be?
Our number is 5%. When we moved to 5% right during the Copom meeting, the consensus was a little bit lower than 5%, and I think the consensus now is moving higher as people are looking at how the process develops.
Exactly. So is there a concern that perhaps then inflation expectations for 2022 will also become higher?
That was actually one of the reasons that we mentioned why we're doing a move that was higher than what the market expected. We mentioned that we understand that 2021 is higher, but 2021 in the horizon only stays for a while because we start moving the window to 2022. But we mentioned that there is always a risk that the short-term inflation starts contaminating the long end, and that's why we thought we needed to move more than what the market expects, because we think moving more has greater efficiency, and at the end, you need to do less.
If we see more pressure on the real because of budget concerns, because of political noise, what will that mean for the central bank?
The real, when you look at the last couple of weeks of months, they have been stable. I mean, it's been a bit volatile, but it's been stable. For us, the important thing is not the real. We think we work under a system of floating exchange rate. The important thing is how the real contaminates the inflation channel through the short-term inflation and through its expectations. And we are watching, we are vigilant on that, and we will act if needed. But as we mentioned, unless something extraordinary happens, it's under our scenario exactly the condition that we're seeing now, and we don't see anything different than 75 basis, which is what we indicated, unless something different happens. But nothing is written on stone. I mean, we could face very different conditions from now on. We don't think this is the most likely scenario, but we do have alternative scenarios, and we have been very transparent about them.
When you say act when needed, what exactly does that mean? What level would that the real be at?
It's difficult to say because it's not about the real. It's about how the real influences the expected inflation in the current inflation in the short term, and how it influences the expected inflation that
Okay, so you said that the pass-through has declined, right, from the real, but with the real close to 6, could you say that it's now increasing again?
No, what we said was that the persistence of the real at the level that was with a high level of devaluation, the persistence has indicated to us that the high persistence have contaminated more prices. But again, when you look at the real and you look at commodity prices in the short term seem to have stabilized a little bit. But again, we don't work on supposition, on supposing things. We need to see how that develops, remembering that our time horizon is 2022 now.
Right. Are you, in the meantime, though, considering any additional instruments to stabilize the currency markets?
No, we are not considering. In the currency market, no. Again, the currency market in the currency market, we think FX is floating. So we do intervene when we think there is a dysfunction in the way the FX is trading. But we don't target a level. We don't have a level in mind, and we don't target FX because it has influence on inflation or on inflation expectations. We take it as given, and we only act on FX when we think the market is dysfunctional. We think the floating regime has served us well, and we think it's very important to communicate that we believe in the principle of separation.
No regular dollar sales from the reserves then?
No, we've never done regular dollar sales. What we've done is when there is a dysfunction in the market, we try to see what kind of dysfunction that is and how much it would take to fix that. We think about a volume that we should use in the intervention, and we slice this volume in a couple of days. Let's
talk about fiscal risk, because you've been very vocal about the fiscal risks around, also about the impact on monetary policy, the spending cap rule that could be breached. We have these talks ongoing. What could force you to take another look at your economic outlook, at your monetary policy outlook?
Again, it's the same as the question that you just asked about FX. I mean, we don't have a target for fiscal. We do believe that the fiscal is imposing a premium on the curve, And this premium contaminates expectation that ends up contaminating inflation. We think it's very important to pass a message of fiscal discipline. We don't think we are in any kind of fiscal dominance effect, but we do think that because we had a very large expenditure facing the pandemic, it's important to pass a message that we had an extraordinary year that needed extraordinary measures, but we are going to go back into converging the fiscal path. That's what we have been expressing, remembering that central bank doesn't do fiscal policy, so we take it as given.
Let's take a look at the global macro environment as well, because of course central banks in developed economies have pledged low interest rates for longer. But how much time do you expect Brazil and other developing nations to have before big central banks start turning the tide?
I think we have a process in place in which all this new stimulus and everything that's happening is repricing the probability of inflation in advanced economies, and that has an impact in emerging market countries. It doesn't mean that you're going to see a surge in inflation in developing advanced markets. What it does mean is when you look at markets, they are seeing that things are starting to happen in the same window of time, which is you have more stimulus, you have the vaccination, which enable the countries to reopen the economy, and at the same time, people question more and more the ability to do an organized exit strategy. So if you take these three elements, what the market is doing is repricing inflation in the advanced economies. And you can see that looking at the break-even in the US and some other countries. And what that does is has an impact on emerging market countries because commodities are rising. With commodities rising, what you do have is an impact on inflation in emerging market countries. Remember that contrary to the past, now you have commodities rising without the currencies of emerging market countries appreciating. So that feeds into an effect. And what we're seeing is that you have this food inflation element in most of emerging market countries that starts to contaminate the inflation numbers.
Are you worried about a surge of outflows if we see a surprise, not perhaps tightening, but perceived tightening in advanced economies?
No, when we look at outflows, and you need to characterize what that is. When you look at fixed income, Brazil has at some point in time a participation in foreigners of the public debt of more than 22%. It's now down to 7%. So right now the participation of foreigners in the fixed income curve in Brazil is not that big. We've seen large outflows. I think we have stabilized. When you look at the equity world, I think it has a different dynamics because it's looking at growth potential. It's more correlated with external indexes. So no, we don't think that is a huge problem in terms of external outflow, but we do think that we need to do our homework to get the inflows back. Remembering also that when you look at the outflows and the inflows, there is a new element, which is on the way back of the outflows that we had in March of last year, a lot of it is going to China. So China is absorbing more and more the inflows to emerging market countries, and that put us in a different situation that we were in the past.
We have seen some negative news when it comes to vaccinations, whether it's problems with J&J or AstraZeneca. Are you factoring those in when you're looking ahead to the economic outlook for Brazil, given that infections continue to surge?
Well, what we do is, again, we are not responsible for vaccination, but what we do is we need to understand how is the reopening of the economy is going to happen. So basically, the exercise that we do is very simple. We look at all the doses that have been purchased, and there is a compromise to deliver. We imagine that all these doses that the government has been purchased, we applied into people, and then we do curves, taking all the age groups, going from the older to the younger, seeing, by June, how much people we are going to have vaccinated and what is the break-even in terms of the age group. And when we look at that, actually, and on the top of that, we designed two curves. One of the first dose in terms of the impact on hospitalization and deaths, and also we look at this second dose. And when you look at those curves with the numbers that we have, we think that we have all the conditions to start reopening the economy in the second semester. So on the contrary, when we look at the doses that we have and what we are able to do in terms of vaccination, we become more optimistic about the second semester.
President Campos Neto, finally, we are seeing a lot of political noise in Brazil. How often do you speak to Minister Guedes, to President Bolsonaro? How close is the coordination, especially when it comes to market signaling?
No, I think the coordination between the Minister of Economics and the central bank in times of crisis need to be a very good coordination, and we are very coordinated. Remember that one thing that we've learned from the crisis in 2008, that you need monetary policy and fiscal policy to be very coordinated. So everything was very coordinated, but we divided into two different parts. If you think all the measures that are taken to face the pandemic, basically what you do have is you have direct transfers, you have avoiding taxes or delaying taxes, and those are the Ministry of Finance, because those involve fiscal. Then you have monetary policy and credit measures, liquidity plus capital, injection of liquidity plus capital, and that is the central bank. And the place that we work together is on the credit measures. We design some of the credit policies together, but remembering that whenever it involves a subsidy or a transfer from the Treasury, the central bank doesn't get involved. We don't want to mix monetary policy with fiscal policy. That's very important for us.